Most traders see the move after it happens. The real edge is learning how to read change of character inside market structure before the shift is obvious. Welcome to the Calm Lucro channel. By the end of this video, you will understand how change of character fits into smart money concepts and ICT, how liquidity drives these transitions, and how to use this masterclass concept to make smarter trading decisions. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Now, let's begin. What are the basics of change of character? A change of character, or CHoCH, occurs when the dominant market momentum begins to fade, signaling a potential transition in trend and order flow. This shift often marks the moment when buyers lose control and sellers step in, or vice versa. Technically, it appears as a break in the most recent structure, suggesting that the market environment may be changing. So, how do we identify a valid change of character in the market? In a bearish scenario, a change of character takes place when price breaks and closes below the most recent major low and the latest demand zone. The same concept applies to a bullish scenario. For example, when price is in an uptrend, consistently forming bullish structure breaks. A shift occurs when it breaks through the most recent major low within the demand zone, signaling the first change of character. The downward momentum then continues as price pushes through the next demand zone and higher low, resulting in a second change of character. This dual change of character suggests an impending shift in market structure. At this point, we can anticipate price entering a bearish order flow. Consider this crucial point. Every time a zone breaks, an opposite side zone automatically forms. Since the price has broken several demand zones, a supply zone has been created at the extreme. Therefore, our expectation is for the price to push higher toward the extreme supply zone. If the price reacts to this zone, we can enter the market by placing sell positions. Our anticipation for the price is to form successive bearish breaks of structures to the downside. Now, to fully understand why price behaves this way, we need to understand liquidity and how it really works in the market. To understand the logic behind a change of character, we first need a clear view of how liquidity functions within the smart money framework. Before moving into patterns and executions, it is essential to understand how these concepts operate in real market conditions. So, imagine that major financial institutions, often referred to as smart money, are interested in purchasing a currency pair. To do this, they require a significant number of sellers and corresponding sell orders in the market. This is essential because without available sellers, no transactions can take place. Therefore, smart money needs to trigger the stop-loss orders already present in the market to execute their buy or sell positions. This is why the market often creates scenarios that make traders believe they understand the direction of price. This situation creates an illusion among retail traders, leading them to believe they are trading on the right side of the market. However, contrary to their expectations, price moves toward their stop-loss levels, and after triggering these stops, it resumes its original direction. Identifying liquidity on the chart is essential for understanding this behavior. These areas, where significant volumes of orders are present, provide valuable insights into market dynamics and help prevent substantial losses. Now that we understand how liquidity works, the next step is to see where it forms on the chart. Because in real market conditions, liquidity is not random. It builds in specific locations known as buy-side and sell-side liquidity. So what exactly is buy-side and sell-side liquidity, and where does it form in the market? To understand this clearly, we need to look at how price behaves inside a range and how liquidity builds before a major move. When price moves within a consolidation or any structured phase in the market, it often forms visible reference points such as equal highs, equal lows, trendline touches, or repeated reaction areas before the next major move begins, whether that is continuation or reversal. Within these structures, we typically observe zones where price consistently reacts, forming areas of support below and resistance above. Retail traders typically look to buy when price approaches a lower boundary or a perceived support area, placing their stop losses just below it. This creates a concentration of orders beneath that zone, made up of the stop losses of buyers, ready to be triggered. In addition, it often includes sell stop orders from traders expecting a breakdown, believing price will continue lower once that level is taken. On the opposite side, when price approaches an upper boundary or a perceived resistance area, many retail traders look to sell, placing their stop losses above it. At the same time, buy stop orders begin to accumulate from traders expecting a breakout. This creates another concentration of orders above the structure, with multiple types of positions clustered in the same area. Therefore, buy-side and sell-side liquidity do not exist only at traditional support and resistance levels. They form wherever there is a concentration of orders in the market. Buy-side liquidity refers to areas where buy orders are clustered, often above highs or key reference points, while sell-side liquidity refers to areas where sell orders are clustered, typically below lows or areas where traders expect breakdowns. Now, let's take a closer look at how buy-side and sell-side liquidity appear in the market through what we call static liquidity. Static liquidity refers to specific areas in the market where a large concentration of orders is resting, including stop losses as well as buy and sell orders waiting to be triggered. When a trader gets stopped out of a position, the market absorbs the orders associated with that stop. This is part of how liquidity is created and taken from the market, allowing price to continue moving. The idea is simple. The market requires liquidity to generate movement. If price does not interact with liquidity before reaching a key level, it will often use that area itself as a source of liquidity to fuel the next move. Static liquidity can be identified in various areas on the chart, such as below equal lows and above equal highs, above swing highs and below swing lows, around trend lines and channels, and within other important reference areas where traders tend to place their orders. These also include commonly observed zones, such as support and resistance, Fibonacci levels, and key regions within a candle structure. What matters is not the tool itself, but the fact that many traders are making decisions around those same levels. Having a clear understanding of these liquidity zones highlights how strongly they influence price movement. Some of these areas become especially important because they are widely recognized, attracting more stop losses and pending orders, which increases the probability of price moving toward them. Next, we examine how the market responds when it approaches these zones. Suppose price is moving toward a visible area where many orders are likely to be resting, and traders begin positioning themselves based on that expectation. If price pushes beyond that level, it triggers those orders, creating a surge in activity as positions are forced to execute. This reaction generates momentum and often leads to a sharp movement as liquidity is being taken from that area. In simple terms, the market moves from one area of liquidity to another, driven by orders being triggered and absorbed. And this is exactly what leads to the shifts we identify as a change of character in the market. Looking at the chart, we notice that after the mitigation of the extreme demand zone attributed to the change of character wave, the price reversed its direction, pushed lower, broke through, and closed below the newly generated lower low. Subsequently, the price formed a pullback, rose back up, reacted to another supply zone, and then continued pushing down, breaking another structure. It is evident that the market's overall bullish structure has changed to bearish after the formation of the change of character pattern, and the price entered the bearish order flow phase. So a change of character involves changing the market's overall trend from bearish to bullish or from bullish to bearish. Let's consider another market structure where the price has formed a change of character by breaking and closing above a major high. Additionally, we see that the price breaks through this supply zone. It's noteworthy that the price has not left any unmitigated supply behind. As you can see, all the supply zones have been mitigated. This means that as the price breaks through the latest supply zone, it signifies the formation of a demand zone. As mentioned earlier, whenever a zone breaks, an opposite side zone is automatically formed. Therefore, a newly generated unmitigated demand zone emerges at the extreme. Considering this, entering a long position based on this demand zone is a viable option. There is a high probability that the price will return to this demand zone, react to it, and then change its direction to the upside. This expectation is supported by the prior formation of a bullish change of character, indicating an upcoming shift in the market structure towards a bullish trend. In this situation, the price has a great opportunity to retrace back down, touch our newly generated demand zone, activate our pending buy order, and then push to the upside. Now let's move into the essential criteria and rules we need to consider to identify valid and high-quality change of character patterns in the market and understand how we can use them to our advantage. The first criterion to identify a valid change of character is higher time frame mitigation. A change of character is valid only if the price reverses and originates from a higher time frame supply or demand zone before breaking the recent major structure and initiating the change of character. If the price creates a change of character without interacting with a supply or demand zone, even with a valid candlestick pattern, it cannot be considered a valid change of character. This is crucial because it helps us identify high probability points of interest and valid reversal patterns, preventing us from falling into traps caused by false reversals and trading in the wrong direction. For example, consider a bearish market structure where sellers are in control. The price has formed a series of bearish breaks of structure and supply zones associated with these structure breaks. In the following scenario, we see that the price moved upwards after indicating a tiny rejection from the last supply zone. The price broke and closed above it. Here we are facing a common scenario that frequently occurs in the market. Many novice traders who haven't correctly identified the market structure often consider this upward movement as a change of character, a signal of a reversal in market direction. They believe that the bearish phase has ended and it's an ideal time to go long with the newly formed demand zone. They typically place their stop loss just below this new demand zone. However, contrary to their expectations, the price made a brief upward move, mitigated the upper supply, and then continued its bearish movement. This resulted in hitting the stop loss of traders who had taken long positions. They often failed to realize why their stop loss was triggered by the price, and unfortunately, they repeat these actions repeatedly. What they missed here is a crucial point. The price didn't reverse from any unmitigated demand zone. They shouldn't have entered a long position until the price reached a major unmitigated demand area. Their identified change of character was invalid, and the price only moved upwards to mitigate the upper supply zone. It used the last supply zone as an inducement zone to sweep more liquidity and gain more momentum to fuel its downward movement. This scenario highlights that without a proper understanding of market structure, you're likely to experience losses. Inexperienced traders could have avoided this if they had a better understanding of market sentiment. They would have noticed that their identified change of character was not valid because the price hadn't reached the higher time frame demand zone yet. Now, let's move into the next confluence criterion for identifying change of character with high probabilities: liquidity sweep. To obtain additional confirmation in identifying high-quality change of character patterns indicating an upcoming market structure shift, we should wait for the price to establish static liquidity zones near our identified higher time frame area of interest. We fully discussed static liquidity zones and their various types and models in the market in detail in our previous episodes. I strongly recommend watching those episodes carefully if you want to have a solid grasp of static liquidity zones and understand their profound impact on market price direction. However, let's have a quick breakdown of them here. As you know, static liquidity refers to the specific zones in the market where a large pool of money is resting, such as stop losses, buy or sell orders, and can also be found in various areas on the price chart. When we talk about static liquidity, there are a few patterns that show up all the time in the market, and they're super practical to spot. I'm talking about things like equal lows, equal highs, and dynamic trend lines. Each of these fits into some classic chart formations you've probably seen before, like double bottoms, double tops, sometimes even triple tops or bottoms, and of course, those bullish or bearish trend lines that everyone draws. Now picture this. We're looking at a higher time frame, say the 15-minute chart. Price is clearly in a downtrend, and you can see it breaking structure to the downside again and again, forming those BOS breaks of structure. After tapping into the previous supply zone, the price reversed and created an unmitigated supply zone, awaiting mitigation. Now the price is pushing to the upside. Zooming into a lower time frame, like the 1-minute time frame, we see that the price has formed a series of higher highs and higher lows on its path toward the 15-minute time frame supply zone. Just before tapping into the supply zone and right below it, the price created equal highs, forming a double top that accumulates great liquidity near our identified higher time frame supply zone. We see that the price sweeps the liquidity accumulated above the double tops, taps into the higher time frame supply zone, reverses its direction after mitigating the 15-minute supply zone, pushes downward, and creates a change of character by breaking and closing below the most recent major low, eventually breaking through this demand zone formed by the break of structure. As mentioned earlier, every time a zone breaks, an opposite side zone automatically forms. Since the price broke through the latest bullish demand zone, it has formed a supply zone right here, associated with the change of character's bearish wave. So here we have the confluence factors that we were looking for to identify a high-quality change of character pattern that provides a high probability in the market. After mitigating the higher time frame supply zone and conducting a liquidity sweep in the current time frame, a change of character formation occurs. In the next step, we can place a sell limit order at the lowest point of the newly generated supply zone, setting the stop loss a few pips above the highest point of the zone. For the take profit, we can either set it at the unmitigated demand zone of the higher time frame or target the current time frame swing low. Recognizing a liquidity sweep pattern before the price reaches our identified area of interest is crucial. This pattern confirms the strength of our supply-demand area. We use liquidity sweeps as a confirmation factor. The idea is simple. The market requires liquidity for momentum. If the price doesn't sweep liquidity before a key level, it often uses that zone as liquidity to fuel its momentum. As a result, if the price taps into a higher time frame supply or demand zone without sweeping liquidity and subsequently shows a rejection, then also creates a change of character pattern on the lower time frame, there is a high chance that the price will continue moving in the opposite direction of the newly generated change of character. This can also trigger stop losses of traders who entered the market expecting that the price would change its primary direction after the emergence of the change of character pattern. Now, let's proceed to the next criterion, which is the double zone breakout. For a change of character pattern to be more effective with a higher chance of success, the price should break and close below or above two successive supply or demand zones along its path. For example, in this scenario, if the price breaks through this demand zone, we have a double zone breakout because the price breaks out of two successive demand zones with a bearish single leg movement. This pattern will be a strong confluence and confirmation for entering the market by opening short or long positions, depending on the bearish or bullish order flow. Let's consider a scenario where the price only created this supply zone. The price broke through and closed below the two demand zones, leaving a significant inefficiency behind. This provides a strong confirmation after the emergence of the double zone breakout. Subsequently, a newly generated strong supply zone forms at the extreme. In this case, we can place a sell limit order at the extreme demand zone because the price has a great chance to return, fill the inefficiency left, fulfill the orders, tap into the order block, mitigate the supply zone, and then push to the downside. Considering the concept of a double zone breakout or even multiple zone breakouts in your trading will enhance your confidence in your trading journey, making you more certain about your trades. Now, let's explore another possible scenario of a double zone breakout that you might frequently encounter in the market. Once again, we have the same scenario with only one difference. The price couldn't break through the second demand zone with a single downside movement. We see that the price broke through the last demand zone and created this supply zone at the extreme. Then, the price experienced a temporary pause and a pullback, but it couldn't mitigate the extreme supply zone. Instead, it formed a liquidity pool by creating a double top. Subsequently, the price pushed to the downside and broke out of the next demand zone. Since a demand zone has been broken, a new opposite side zone will be created, which is this supply zone. As mentioned earlier, the upper supply zone is the extreme one, and the second supply zone, located a bit lower, is called the decisional zone. Please consider that we cannot place any trades based on the decisional supply zone because there is a high chance that the price will push higher to sweep the liquidity accumulated above the double tops and trigger the stop loss of traders who entered from the decisional supply zone. If you had entered the market from the decisional supply zone, there is a high chance that the price will push higher to mitigate the extreme zone and also sweep the liquidity accumulated along its way. If you had an order, you would be part of that liquidity. What we should do is wait for the price to sweep the liquidity accumulated in the market, tap into our extreme supply zone, and then we can enter the market. To wrap up, mastering the concept of change of character is essential if you want to stay ahead of market shifts and avoid getting caught in traps. Please also remember that the mission of the Calm Lucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, Technical Analysis for Day Traders, Trading Psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the Calm Lucro Trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.